Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's 169th CP program organized by AASB of ICI for this council year. And today we are going to take two important topics, terms of audit engagement and audit documentation. As we all know, both the topics are interrelated and very important, as documentation is very important for any of the audit. So in order to tackle these two very important topics, we are having with us C. Asta Gupta ji. So on behalf of AASB of ICI, I extend my warm welcome to you, Asta ma'am. Namaste. We are also having C. Rashi Talwarji as a moderator for today's webinar. So I also welcome Rashi Talwarji. Namaste, madam.
Thank you.
I also welcome all the participants of today's webinar. Honorable Chairman Sir and Honorable Vice Chairman Sir are both busy in another of the meetings. So I'm taking this liberty to start the webinar. So without taking much more time, I request Rashi Talwar Madam to please start the proceedings of today's webinar. Over to you, Rashi Madam, please.
Thank you so much, sir, for the handover. A very good evening and a very warm welcome to the entire fraternity in today's program. Thank you so much, Anil sir, for organizing the series of informative webinars where experienced professionals come together to guide and advise other professionals so that we all can ensure and deliver high quality audits. And a very big thanks to entire panel for providing me an opportunity to be a moderator for today's session. So today we're having an eminent speaker with us who will be sharing the professional insights, key challenges, as well as opportunities on the topic, terms of audit engagement and audit documentation. It is one of the hot topics and very important in today's era. Just to give you a brief about today's topic, the terms of audit engagement basically establishes a clear understanding between the auditor and the client, typically outlined in an engagement letter. They include the objective and scope of the audit, responsibilities of both the parties, the form and content of the audit report, the basis of audit fees, and various other things. And audit documentation, also known as working papers, records the audit procedures performed, evidence obtained, and the conclusions reached. It provides evidence of the audit work, supports the audit conclusions, aids in planning, supervision, and ensures quality control. Now, I would like to introduce our speaker, CA Asta Gupta. She is currently a partner at SK Gulati and Associates, a 35-year-old Delhi-based firm of chartered accountants since last 4 years. Her professional experience ranges across statutory audits, personal and corporate taxation, income tax assessments, GST compliances assessments, and advisory. She's also been a part of Big Four, EY. Other professional roles would include, she's also been invited as a guest speaker at numerous sessions organized by the ICI to deliberate on standards on auditing. She has addressed more than 2,500 chartered accountants, both offline and online. She's convened technical sessions organized by the ICI on INDES. Recently, she's also been appointed as a member of Financial Reporting Review Board of the ICAI. She's been invited as a guest speaker by the Delhi Board of School Education for counseling students on the chartered accountancy as a career. She is adjudged elocution competition of CA students organized by the NIRC of the ICAI. She's won many technical paper presentations across the country in the National Conference for CA students organized by the Board of Studies, ICI, during her student days. I hope you're all impressed as I am. So now I would like to request CA Asta to start her session.
Thank you, Rashi, for such a warm introduction. Before I begin my today's webinar, I would like to extend my heartfelt thanks to the Auditing and Assurance Standard Board, AASB of ICAI, Chairman Sir, Vice Chairman Sir, Anil Sir, and the entire team for hosting these webinars on such a regular frequency for the betterment of professional fraternity. It's a good opportunity for new chartered accountants like us to come and to get this stage to speak, and also it's a good learning opportunity for the audience as well. So without any further ado, in any way, Rashi has set the tone of today's webinar in a very good way. I'll just quickly open my PPT and start. Is the screen visible? You can give me a thumbs up.
Yes, ma'am.
Okay, great. So in today's topic, we will be addressing two very basic yet important standards on auditing: SA 210, which talks about terms of audit engagement, and SA 230, which talks about audit documentation. So I have divided my PPT into two parts. First, I will begin with SA 210, which is agreeing the terms of audit engagements. And once we are done with completing the important elements of SA 210, we'll move on to SA 230, which talks about audit documentation. So, what is the objective of SA 210? It talks about auditor's responsibility. What is the auditor's responsibility? Agreeing with the terms of audit engagement with the management, which means there has to be existence of preconditions of audit, which means that in order to conduct audit, there have to be certain conditions in place, then only the auditor can conduct the audit. Next, confirmation, which talks about common understanding between the auditor and management regarding the terms through an engagement letter or a contract. So what are the preconditions of audit which form part of the audit engagement? First, preparation of financial statements as per applicable financial reporting framework. Second, presence of internal controls to prepare financial statements free from material misstatement. Access to auditor to the records, documentation, information relevant for preparation of financial statements, access to additional yet important information, like in case of consolidated financial statements, the auditor would require the information regarding joint ventures or associates, and lastly, access to employees or third parties which are relevant for the audit perspective. Whenever you go for an audit, normally you get a SPOC, a special point of contact. So this is the point which is covering here. So in case of employee, obviously you'll have to have access to the employees of the accounts or the finance team. And when you talk about third parties, they include legal experts, valuers, bankers, whose input is important for the audit perspective. Now, we will continue some preconditions of the audit. Let's talk about the management responsibility. The basic responsibility of the management is to prepare the financial statement as per the applicable financial reporting framework. We will call FRF for the purpose of brevity. So there are two kind of financial reporting framework of the financial statements. First, we have a fair presentation framework. Next, we have compliance framework. What is fair presentation framework? A few examples of a fair presentation framework would be where the financial statements are prepared in accordance with the accounting standards prescribed under Section 133 of the Companies Act, or in accordance with the accounting standards issued by the ICAI. So most of us are actually, we get our financial statements prepared as per the fair presentation framework defined in this particular part of the table. When we talk about compliance framework, these are special circumstances. For example, when the financial statements are required to be prepared in accordance with the Banking Regulation Act or the Insurance Act. So there are certain statutes which give different financial reporting framework, and that is where the compliance framework comes into place. Now, how to determine if the financial reporting framework that has been used by the management is acceptable for the purpose of audit or not? So there are certain factors. It depends upon the nature of entity, like is it a corporate, a non-corporate, a non-profit organization, banks, insurance company, etc. So depending upon what kind of entity you're auditing, you'll have to see the financial statements are prepared as per the applicable financial reporting framework. Next, purpose of financial statements, whether they are general purpose, whether these financial statements have been prepared for the purpose of loan application, renewal, which will be categorized into special purpose. So few examples of general purpose financial statements would be, like I explained before, accounting standard issued by the ICAI, accounting standard notified by the Companies Accounting Standard Rules 2021, IFRS issued by the IASB. So these are basically general purpose financial statement, which most of us would be anyway preparing and auditing. Nature of financial statements, whether it is single entity or it is consolidated financial statements, again, depending upon the nature of entity that you're auditing. Then, financial reporting framework prescribed by the law or regulation. If you refer back to my previous slide, wherein I had defined the compliance framework. So depending what kind of law or regulation is applicable to the entity that you're auditing, the financial reporting framework should be chosen accordingly. We will come back to the objective and continue there. So I had mentioned that the auditor's responsibility has to be there, and we had given some points regarding that. What is the auditor's responsibility? So I had mentioned that we need to agree with the terms of the audit engagement with the management. So again, existence of preconditions of audit I have defined, and the confirmation. Common understanding between the auditor and management regarding the terms through an engagement letter or a contract. Now, very importantly, let's talk about the terms of audit engagement. And now we need to understand when I talk about the confirmation or when I talk about the engagement letter that needs to be there between the auditor and the management. The management also has a certain, different terminology depending upon the nature of entity that you're auditing. So the terms of audit engagement are for whom? Those charged with governance, which means in case of a company, the engagement will be with the board of directors. In case of a trust, it will be with the trustees. In case of a partnership firm, the terms of the audit engagement letter will be with the partner. And in case of a branch or a liaison officer, whoever person has been authorized there to represent the entity, with that person, the terms of audit engagement will be defined. Very importantly, let's talk about the format of the engagement letter. So, in the whatever experience I've had in the field of audit, I've just seen, especially with the small and medium practicing CA firms, this is a very basic requirement, and due to paucity of time, or maybe due to lack of knowledge or lack of experience, this very basic step is never covered. And most of the common complaints that I get across is that, we're not aware of the format that has been defined. We don't know what kind of letter should we use to interact with our clients. So in that case, I would always suggest you to go back to your basics. You refer to SA 210, which is issued by the ICAI. And at the end of the SA 210, they have given very good illustrative formats for the engagement letter. And in case, if any of you have been exposed to using a CA-GPT, so there is a CA-GPT dedicated to the auditing, auditing and assurance standard board, auditing standards. Therein also, if you define or if you give the command to generate an engagement letter for a company or engagement letter for a partnership firm, it will give you a requisite format. You just need to alter it according to, your client's name, address, etc. So just for the benefit of everybody, I thought, although it's a very basic requirement, but it's very important and most of us miss it. So I thought that I'll, break down the engagement letter format, and I will also, share the illustrative format side by side. So let's begin with that. So first things first, in an format of an engagement letter, the first part is the objective and scope of audit of financial statements. So I'll parallelly open a sample engagement letter. Give me a second. Okay. So the first part of the format of engagement letter will talk about the objective and scope of audit of financial statement. So this is what a sample engagement letter looks like. For if I am auditing, let's say a private limited company, so I will address it to the board of directors of the private limited company. I will put in the address and then address them. So here, if you look at this paragraph, it states that you have requested that we audit the financial statements of the company as defined in Section 240 of the Companies Act. And the financial statements will include applicable CFS, company subsidiaries, etc. by the means of this letter. So this is the part wherein I'm defining the objective and the scope. Here, the audit will be conducted with the objective, here comes the objective part, of our expressing an opinion if the aforesaid financial statements give the information required by the Act in the manners are required and give a true and fair view. Just a second. Just close Grammarly. Yeah. So coming back to the scope again, our audit will be conducted with the objective of expressing an opinion if the aforesaid financial statements give the information required by the Act in the manners are required and give a true and fair view in conformity with the applicable accounting principles generally accepted in India of the state of affairs of the company as on 31st March 22 and the profit and loss or cash flow for the year ended on that date, which inter alia include the reporting in conjunction where the company has an adequate internal financial control system or financial reporting in place and operating effectiveness of these controls. In forming our opinion on the financial statements, we will rely on the work of the branch auditors appointed, and the report would express the state and fact of such reliance. So this is the part wherein I'm giving the objective and scope. Let's move on to the next part of the engagement letter. Responsibilities of the auditor. So coming back to my sample letter, here, this particular paragraph and these points will cover the responsibilities of the auditor that is defined in the terms of the audit engagement. So it states, we will conduct our audit in accordance with the standard of auditing specified under section 143(10) of the Act. Those standards require that we comply with the ethical requirements. As part of an audit in accordance with the essays, we exercise professional judgment and maintain professional skepticism throughout the audit. We also, so one by one, the responsibility have been given. Responsibility for identify and assess the risks of material misstatement of financial statements, whether due to fraud or error, design, and perform audit procedure responsive to the risk, obtain audit evidence, and is sufficient and appropriate to provide a basis of our opinion. The risk of not detecting a material misstatement resulting from fraud is higher than for one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentation, or override of internal controls. Second, obtain an understanding of internal controls relevant to audit in order to design audit procedures which are appropriate in the circumstances. Under Section 143(3)(1) of the Companies Act, we are also responsible for expressing our opinion on whether the company has adequate internal financial controls system in place and operating effectiveness of these controls. Next, evaluate the appropriateness of the accounting policies used and the reasonableness of the accounting estimates and related disclosure made by the management. Conclude on the appropriateness of the management's use of going concern basis of accounting, and based on the audit evidence obtained, whether a material uncertainty exists related to the events or condition which may cast significant doubts on the company's ability to continue as a going concern. If we conclude that a material uncertainty exists, we are required to draw attention in an auditor's report to related disclosures in the financial statements, and if such disclosures are inadequate, to modify our opinion. Our conclusions are based on the audit evidence obtained up to date of the auditor's report. However, future events or conditions may cause the company to cease to continue as a going concern. Lastly, evaluate the overall presentation, structure, and content of the financial statements, including the disclosures, and whether the financial statements represent the underlying transaction and events in a manner which achieves fair presentation. So these are very basic auditor's responsibility, which form part of the engagement letter. Let's move on to the next component of engagement letter, responsibilities of the management. Now, I, as an auditor, if I'm conducting the audit, I have defined my responsibility. And since the second party to the audit is the auditee, which is the management, so their responsibility should also be well defined so that there is no confusion during the course of audit. So let's see what are the responsibilities of the management and how are they defined in the engagement letter. Here. So if we look at this paragraph, it says, our audit will be conducted on the basis that the management and those charged with governance acknowledge and understand that they have the following responsibilities. So very importantly, when we talk about the auditee, the broader term would be those charged with governance, which includes the management. That is why they have given both management and those charged with governance here, because it depends upon the entity that you're auditing. If you refer back to my slide where I had defined that who are the people who are covered under the definition of those charged with governance, which mentioned, wherein I had mentioned the trustees, the partners, so that's why you need to mention both management and those charged with governance. In case you're very much clear that, I'm auditing a company, so I could have also written the management here and that would have been sufficient. So let's have a look at the responsibilities of the management. A, for the preparation of financial statements that give a true and fair view in accordance with the applicable financial reporting standards and other generally accepted accounting principles in India. This includes the compliance with the applicable provisions of the Act, which talks about the Companies Act, since we're auditing a company here, proper maintenance of accounts and other matters connected therewith, responsibility for the preparation of the managed financial statements on a going concern basis, preparation of annual accounts in accordance with the applicable accounting standards and providing proper explanation relating to the material departure from those accounting standards, selection of accounting policies and applying them consistently, making judgments and estimates which are reasonable and prudent so as to give true and fair view of the state of affairs of the company at the end of financial year and of the profit and loss of the company for that period. Taking proper and sufficient care for the maintenance of adequate accounting records in accordance with the provisions of the Act for safeguarding the assets of the company and for preventing and detecting fraud and other irregularities, laying down internal financial controls to be followed by the company, and that such internal financial controls are adequate and were operating effectively, and devising proper systems to ensure compliance with the provisions of all the applicable laws, and that such systems were adequate and operating effectively. D. Identifying and informing us, by us I mean the auditor, of financial transactions or matters that may have an adverse effect on the functioning of the company. C. Identifying and informing us of all the pending litigations and confirming that the impact of the pending litigations on the company's financial position has been disclosed in its financial statements. All material foreseeable losses, if any, on long-term contracts, including derivative contracts, and the accrual of such losses are required under any law or accounting standards, and any delay in transferring amounts required to be transferred to the Investor Education and Protection Fund by the company. D. Informing us of the facts which may affect the financial statements or which management may become aware during the period from the date of our report to the date of financial statements are issued. E. Identifying and informing us as to whether any director is disqualified as on 31st March from being appointed as a director in terms of Section 164(2) of the Companies Act. This should be supported by written representations. So we're also covering the audit documentation part here. Received from the directors as on March 31st and taken on record by the Board of Directors. F. To provide us with access at all times to all the information, which is obviously relevant information, including the books, accounts, vouchers, and other records and documentation of the company, whether kept at the head office or elsewhere, of which the management is aware that are relevant to the preparation of financial statements, such as records, documentation, and other matters. This will include books, so account maintained in electronic mode. Access at all times to the records of all the subsidiaries, including associate companies and JVs of the company insofar it relates to the consolidation of the financial statements. Then, access to all reports, if any, relating to internal report on financial frauds, like vigil mechanism reports, etc., including those submitted by the cost accountant or company secretary in practice, to the extent it relates to reporting on fraud as per the applicable provisions of the Companies Act. Additional information that we may request from management for the purpose of our audit. So basically, in this part, we are actually including the residual information that may be relevant for the audit purpose, but are not, but cannot be defined at the beginning of the audit itself. Unrestricted access to persons within the company from whom we deem it necessary to obtain audit evidence. This includes our entitlement to require from the officers of the company such information and explanation as we may think necessary for the performance of our duties as the auditors of the company, and all the required support to discharge our duties as statutory auditors as stipulated under the Companies Act 2013 and essays and applicable guidance. So this is the management responsibility. The idea is to define it here now and then so that there is no confusion later on. And the management is also well prepared, at the time of the start of the audit itself. There are some additional points also, like we also say that as part of the audit process, we will require from the management written confirmations concerning representation made to us in connection with our audit. Let's move on to the next component of the engagement letter. Identification of applicable financial reporting framework for preparation of the financial statements. So in my previous slides, I had defined what kind of financial reporting frameworks are there, and it is one of the preconditions of start of the audit, and what are the different factors that help us as auditors to identify what financial reporting framework is applicable to preparation of financial statements. So herein also, we need to give a paragraph regarding that, in fact, we've also mentioned here when I was defining the management responsibility, that the management is required to identify the applicable financial reporting framework and prepare financial statements in accordance to that. Next, requirement of auditor to communicate key audit matters CAM as per SA 701. So if you refer to SA 701, it is actually applicable to listed entities only, because in this particular format of the engagement letter, this has been addressed to the auditor of private limited companies. That's why the component regarding the communication of key audit matters is not included here. However, it is a very good audit practice to include this as a part of your engagement letter. And if you refer to SA 701, and if you want to elevate your audit and you want to see what additional points that I can cover, so it's obviously key audit matters are good and it helps to improve the quality of the overall audit. Inherent limitations of audit. So before I go on to the language that is to be used regarding defining the inherent limitations of audit, let's understand what is the meaning of inherent limitations of internal control or audit. It says that unavoidable risk that material misstatement may not be deducted even if the audit is performed as per the essays. So see, we as auditors give reasonable assurance, not absolute assurance that the financial statements are true and fair view and they're free from material misstatements, because our audit procedure is limited by inherent limitations. And that's why we need to give this as a disclaimer as auditors when we are conducting the audit. And since engagement letter is issued in the start of the audit itself, in fact, before the beginning of the audit, so it is the best place to mention these inherent limitations, that there will be an unavoidable risk that material misstatement may not be deducted even if the audit is performed as per the applicable essays. So let's see what language to be used in the engagement letter for this. Just give me a second. Yes. So if we look at this paragraph here, so I think this comes, yeah. So if you recall the auditor's responsibility part, this is wherein I had mentioned the auditor's responsibility. And this particular paragraph, just after the auditor's responsibility, we mentioned the inherent limitation part. So the language can be this: because of the inherent limitations of the audit, including the possibility of collusion or improper management, override of controls. So we are giving that inherent limitations of audit are there. There could be possibility of increment in the inherent limitation because of the collusion amongst the management or improper management or override of controls, which may not be in the control of the auditor. There is unavoidable risk that the material misstatement due to fraud or error may occur and may not be detected, even though the audit is properly planned, performed in accordance with the essays. So this inherent limitation has to be mentioned. It's a very small paragraph, but I think the small paragraph goes a very long way. It safeguards us as auditors, from not being able to detect fraud or error which are beyond our control. Now let's look at the next component of the format of engagement letter: arrangement regarding planning and performance of audit. So here in the engagement letter, now this particular part is very subjective because it depends upon how big the entity is and what is the nature. So what kind of planning and what kind of arrangements the auditor requires to do, which I think covers the team part, the costing part, etc. Composition of the audit team. Now this is not mandatory, but as a good auditing practice and a good auditor, it is always preferred that the engagement letter should contain the composition of the audit team. For example, there'll be one partner who will be dedicating so and so many hours or so many days. And there's a manager, and then, they could be assistant to the manager. They could be the article assistants. This kind of component gives a clarity to the management that, okay, what kind of caliber, what kind of skill the audit team possesses, so that they can also ready their team accordingly and they know whom to deal with accordingly. For example, a manager would have obviously more experience than an article assistant. So they would also ready their employees accordingly so that they can provide whatever support is required to conduct the audit. Expectation, written representation from the management. So this part I've already covered in the engagement letter. I had mentioned at the end of the management responsibility that the auditor will be seeking written representation from time to time. So this expectation has to be clearly delivered in the engagement letter so that the management is prepared and they do not, object to seeking written representation in the course of the audit. Management to provide draft FS and accompanying information timely. This already has been included in the management responsibility part. Management to share facts impacting the financial statements. With this, I mean the facts which arise after the audit report date, but before the date of issuance of financial statements. So I'm clearly referring to Accounting Standard 4 and SA 560, which talks about the subsequent events. Basis of fee computation and out-of-pocket expenses. So if you're going for an outstation audit and, or even during the city also, we need to understand that how is the fees being computed, what kind of additional costs will be incurred. Let's say there could be a conveyance fee, there could be a daily allowance that you give to the, audit team. And if it's traveling abroad, traveling outside the city, then the conveyance, boarding, lodging, these kind of expenses will be there, which will be borne by the management or reimbursed. So we need to give them an idea, and it's always good to include them in the engagement letter. Then you need to mention the fact that the audit process is subjected to the peer review under the Companies Act, or sorry, under the Chartered Accountants Act 1949. So why is this part important is because this is where the confidentiality part comes into play. That, whatever working papers, whatever information we are taking from you, that can be seen by a peer reviewer, which is a corresponding, CA firm, who will be conducting to the peer review. And then we need to share the information that we have taken during the course of audit and share it with them, so that later on they do not object to the confidentiality part, that you did not seek permission from us to share our information with some third party. So that is why it is important to mention that the audit process will be subject to the peer review. Let me see if this particular letter has a language regarding the same. Yes. So here we can use this language. We also wish to invite your attention to the fact that the audit process is subject to peer review or quality review under the Chartered Accountants Act 1949. The reviewers may inspect, examine, or take abstract of our working papers during the course of the peer review or the quality review. So just so that they do not object to the confidentiality, it is always important to mention this part here, so that the management is also aware that, okay, our information will be shared by the peer reviewers, and and that's what they need to be mentally prepared for that. Okay, now let's go back to the last few components of the engagement letter. Other legal requirements, like resignation of the auditor as per Companies Act or SEBI. So if there are certain legal requirements which may be applicable, which you think as an auditor should form part of the engagement letter, that needs to be mentioned here. Okay. So these are some very basic and important components of the engagement letter. Again, engagement letter is also very subjective, but these elements that I have defined in these two slides are good to have and should be there, so that your engagement letter is talking and it is proper, and it is in compliance with SA 210, and it safeguards you from any kind of risks that may be, which you may encounter during the course of audit or even after the completion of audit. So that is the whole objective of having the engagement letter in place. This particular format that I have picked up is from the illustrative format mentioned at the end of the SA 210. So you can always take it from there. Or even better, please use CA and you can define the terms in the command itself, and it will generate a beautiful engagement letter. And you don't have to give a dedicated staff of making engagement letter now and then. All you have to do is just, change the names and address. And this way you'll be compliant. Your time will also be saved, and the audit documentation will be proper and in place. I'll just shut this engagement letter, and let's go back to the slide. Okay. Now, during the course of audit engagement, there could be certain changes in terms. What happens is that these are standard terms of audit engagement, which were defined in the engagement letter. And due to some reasons, the terms of the audit engagement can be changed. So first, we as auditor need to classify them with whether the terms of the audit engagement are reasonable or unreasonable. So I will, if the terms of the audit engagement change are reasonable, then I'll talk about that later. But if the terms of the audit engagement are unreasonable, when we talk about then you need to see if the nature of the audit changes there to review engagement, and whether you should be taking up this assignment or not, or whether you can negotiate further, so that both the management and the auditor meets halfway, and the change should not be harmful to either of the party. So if the change in terms of audit engagement are reasonable, then you can revise the terms. Now, these are a few, examples wherein the terms of the audit engagement can be revised. You can talk about there could be misunderstanding of the objective and scope of the audit. They could be revised or special terms of audit, which may or may not be conveyed at the time of, initial engagement. What happens is sometimes when we start the audit engagement, in any way, an auditor is, appointed for a period of 5 years, and then it has changed. So year on year, the audit engagement nature is same, but due to certain special regulatory requirements, or maybe the size of the company has grown, that's why the compliance burden has increased, the audit terms can be revised. So this example will fall under this particular bucket, that you can revise the terms of the audit engagement and it is reasonable. Next, change in ownership structure. Obviously, if the ownership structure changes, the nature of the entity changes. If the nature of entity changes, that means the precondition of audit changes, and hence it will result in change or revision in terms of the audit engagement. Then, change in nature, size of business or entity. For example, the limits of the CARO as in the company's auditor report order, they have been applicable on the company now. So your terms and your scope will increase, and which will have a direct impact on the terms of the audit engagement. So in this case, this is a perfect example where it is okay and reasonable to revise the terms of the audit engagement. Change in legal or regulatory requirements. So, for example, there could be a time when certain law or statutes were applicable to the entity. So, you conducted your audit in accordance to that, and the terms of the audit engagement included those legal or regulatory requirements. But later on, suddenly those legal regulatory requirements were no more applicable. So, obviously, it will change the terms of audit engagement. You cannot continue using the same engagement letter. You have to revise it. And that is the perfect example for revision of the terms of audit engagement. Change in financial reporting framework. So you have been using fair reporting financial framework, and suddenly there was certain legal regulatory requirement which the auditee was required to, follow. So in this case, the financial reporting framework will change from fair financial reporting framework to compliance framework. Now, when the compliance framework comes into picture, then again the audit nature will change, and hence the terms of audit engagement will also change. So this is not an exhaustive list. These are some few illustrative examples of when it is appropriate to revise the terms of audit engagement. Now, limitation of scope before the audit acceptance. See, the scope and objective is a very important part of the engagement letter. That's why it is the opening paragraph of the engagement letter, if you recall the format that I had shown in the Word format. So if the management is imposing limitation of scope, then in that case, we as auditor have to give disclaimer of opinion in audit report as per SA 705, which talks about modified opinion. So disclaimer of opinion is a type of a modified opinion. And limitation of scope, it is defined. Whenever the scope of the auditor is limited by the management, you need to give disclaimer of opinion in the auditor's report. So I'll give you an example. The management has not carried out the going concern assessment as per SA 570, but has prepared the financial statements of a going concern basis. So going concern is a fundamental accounting assumption, and the management is responsible for justifying that the entity will continue for the foreseeable future. So the management needs to do some tests and establish some controls and prove to the auditor that okay, my entity will continue for the foreseeable future, for which it needs to carry out a going concern assessment. So that's a certain different rules. It's a proper different webinar on SA 570. But if you as auditor have not received any evidence, and you've not you're not comfortable with the going concern position of the entity, but yet the management has prepared its financial statements as per going concern basis, that means your scope is limited. That means this is a perfect example wherein you need to give a disclaimer. So herein you need to mention that I will give disclaimer of opinion in the auditor's report. Also, as a good practice, you should not accept the audit engagement because it poses a question mark. It's a very risky audit to accept unless it is mandated by law and you have no option to do the same. In case you have to accept the audit, then obviously it is recommended, it is mandatory, in fact, to give disclaimer of opinion in the auditor's report. Okay. What happens when there is an engagement letter in case of a joint audit? So in case of a joint audit, both the auditors, they will give a common engagement letter. If you feel as a part, independent upon what kind of understanding you have with the joint auditor, if your responsibilities are divided, or if your audit portions are divided, then you can mention it, maybe auditor A will do this part, auditor B will do this part. But more or less, the language remains the same, and the terms and the components of the audit engagement letter also remains the same. Okay, so with this, we come to the end of SA 210, which was the terms of audit engagement. And now I will move on to SA 230, which talks about audit documentation. I would request all the participants and all the attendees to please keep on posing the question in the question box. I will pick up one by one. I'll pick them up one by one at the end of the webinar. So, essay 230, it talks about audit documentation. So, what is the importance of audit documentation and why is it relevant? So, first of all, audit documentation is the evidence which proves that the overall objective of the audit has been achieved. Like, if we conduct the audit, we need to have some working papers. We need to tell them, okay, we have checked so and so things, all essays, all accounting standards, all legal compliances have been complied with. So, in order to prove that, we need to have the evidence, and we need to prove it to the management, to other stakeholders. It could be bank, to the peer reviewers, that we have conducted our audit properly. Then next, sufficient record for the basis of audit report. So audit report is the result of the audit. It is it contains the crux that, okay, the management has prepared financial statements as per, applicable financial reporting framework. It is true and fair. It gives a true and fair view. There is no fraud has been deducted. There is no material misstatement. When you give all these kind of statements, there has to be some backing, some proof on the basis of which these, statements have been provided in the auditor's report. I'm talking about the independent, clean or unqualified audit report. So that is wherein the audit evidence in the form of audit documentation comes into place, which works as a backing for whatever statements and for whatever opinion, whether it is unqualified opinion, qualified opinion, modified, disclaimer of opinion, whatever, or emphasis matter paragraph, all these important part of the basis of opinion paragraph of the auditor's report, it depends totally upon the audit working papers, which is your audit documentation. Evidence that the audit has been planned and performed as per the standards on auditing. So standards and auditing is a Bible. It's a Gita. And when we comply to the standard of auditing, we need to give them a proof that, okay, as per SA 210, I prepared the engagement letter. I got it confirmed from the management. So SA 210 has been complied with. If we talk about SA 570, which is going concern, I, as an auditor, I checked with the management. They gave me a basis of going concern assessment, and I'm satisfied that there is no, activity which cause hindrance in the management to continue its business for the foreseeable future. So SA 570 has been complied with. Then similarly, maybe let's talk about SA 580, which talks about written representations. That, okay, I have sought written representation from these stakeholders or these third parties, and I have complied with the conditions laid down in SA 580. So on and so forth. In fact, towards the end of my slide deck, I have given essay-wise audit documentation that needs to be prepared. So this particular aspect will be covered there. Planning, performance, and supervision of audit. See, audit planning forms a very important part of the audit, because as to how will you determine that what kind of audit check will be done, when, by whom, and what will be the audit timeline, at which point of timeline, what kind of milestones as an auditor I'm required to complete. So for this also, I need to have some proof. And for all those firms that have been peer reviewed, I'm sure the peer reviewer must have sat down with you and asked you, okay, how do you conduct your audit? Do you have any evidence? Do you have any checklists in place? Even if it's manual, depending on the size of the audit firm, are you using Google Sheets or are you using Excel sheets? So all these things, that also forms part of the audit documentation. And the stronger the planning is, there is more, the audit process becomes more reliable, the audit report becomes more reliable, and it gives confidence to the stakeholder that, okay, the work that has been done by the auditor is proper. Evidence that the audit has been planned and performed as per the law and regulation. So let's talk about, when you do audits, bank audits, or when you do audit of an insurance company. So herein, when you perform audit there, you need to refer to the Banking Regulation Act. You need to refer to the IRDA. And then you make your audit checks accordingly. You see that, okay, these particular, for example, in case of bank audits, advances and NPAs is a very important component of a bank audit. So regarding advances and NPAs, what kind of checklist is there? Who has performed the checks and what evidence did you gather? What kind of conclusion did you come up to? This is only one part of the audit. So if someone who is reviewing your audit process and sees that, okay, in audit of banks, they have a separate checklist for NPAs and advances, that means that the auditor is well versed with the Banking Regulation Act and knows that this is a very important part of the audit and has given, reasonable timeline there. So the only way the person can get to know is when he looks at the audit documentation, when he looks at the that, okay, these checks have been performed. So if you have performed the audit as per the applicable law and regulation, you need to have the checklist in accordance with that law and regulation. Then accountability of the engagement team. Now, this is a very important part at the audit firm level. Now, bigger the size of the audit firm, it becomes more important and to manage your team, and the visibility also reduces. Now, a partner who is managing a firm which has more than, let's say, 100 employees, it is not feasible for the partner to divulge into divulge at the grassroots level and go through vouching or very basic audit requirements. So he has appointed someone like an N-1, it could be like a senior manager or manager, to look after the team. Similarly, manager will not sit down and do the vouching, right? He will just look at the report, or he will maybe look at the checklist that, okay, article assistant has done these kind of vouching. There was a manager who reviewed them and he noted down the conclusions. And now I, as a manager, need to look at the conclusion, and then I will prepare a report and get it vetted by the partner. So this kind of delegation of work, then who is responsible for what? We also call it responsibility matrix. This is also kind of a documentation with which your auditing team or the engagement team becomes accountable, so that they also don't lose out on their responsibilities, and the partners are able to justify that, okay, my team has done all of this work, this documentation is in place, they have given these many man hours, and this is how the audit report or the audit has been concluded. So this also becomes a part of your audit documentation. So these are a few points which cover the importance of audit documentation, and now we will go into more detail in the coming slides. Timely preparation. So the documentation has to be done either at the beginning and during the course of audit, not after the completion of audit, because during the course of audit, so many things are happening. There is, pressure, there is certain timelines that you need to adhere to. If you sit down and start compiling all the audit documentation after the audit, it is not feasible, because you'll not be able to memorize so many things. And step by step, you need to, whatever audit timeline you are defining, you need to incorporate the timings to prepare the audit documentation in the course of audit itself. And why is it important to incorporate a documentation in the course of audit? Because it enhances the audit quality. It helps the review of the audit evidence obtained. For example, there was a checklist. I conducted the check, and and now I am an article assistant. I did the vouching. Now my manager needs to review whether the vouching was done properly or not, or whatever conclusion the manager is deriving. You need to go back and check that, okay, whether that voucher had that. Show me the voucher which actually has this particular observation. So that's how you review the audit evidence and you recheck, and you get a double assurance that, okay, the voucher on the basis of which this audit observation is going is correct or not. Then review of conclusions reached before the finalization of audit report. Obviously, when you conclude or when you give the final observations in the audit report, you review all the conclusions, because you don't want to be embarrassed in front of the management and say, okay, your audit evidence was not appropriate. You tell us how are you coming to this conclusion. If I don't have any basis, I will not be able to prove my point. So that's how these all 3 points are regarding of double checking, of double assurance, that whatever observation, whatever information you're sharing in the audit report, it has to have a strong backing. And what is that strong backing? It is your audit documentation. Factors on which the audit documentation depends. Size and complexity of the entity. Obviously, bigger the size, more complex the entity, the audit documentation needs to be stronger. It has to be more frequent, and it has to be more detailed. Nature of the audit procedures being performed. Again, whether you're doing substantive testing, whether your sample size is big, and if the entire auditing is being done in a digital manner, if you're doing sometimes you do a desktop review, you're doing the audit in a remote fashion, then the audit documentation changes. So all these factors, they come into play, and this is a part of the nature of the audit procedures. Identified risks of material misstatement. So this is the responsibility of the management, because when you are doing a business, when you're running an organization, you need to be hands-on with what kind of risks the entity faces, and then we as auditor define them, whether they can cause material misstatement in the financial statements or not. So depending, if you think that the risks of financial misstatements are high, then your audit evidence needs to be stronger. It has to be more detailed. Significance of the audit evidence obtained. Sometimes what happens is that when you're conducting the audit evidence may or may not be very big, right? If it's not very big, then you know that, okay, it's not material and it's not going to make any difference. So I'll just keep it, but I will not divulge further into the audit procedure. We'll close it for a particular balance sheet or profit and loss item. But when you are getting a certain kind of audit evidence where you feel that no, there could be more, I as an audit team need to dig in more. So because it is due to that audit evidence which gave you a clue that okay, there could be more into this particular component of the profit and loss. So I will divulge more. So that is how the audit evidence obtained significance comes into play. Audit methodology, that what kind of audit methodology are you using to conduct the audit? Okay. Now let's look at certain items which are not to be considered as audit documentation. Not every document or not every evidence that you obtain classifies as an audit documentation. This has been defined in SA 230. Again, this list is not exhaustive. You can add on to it depending upon your experience and the nature of entity you're auditing. But I'm giving a few standard examples that we as auditor can keep them in mind, and we don't have to put in extra effort to maintain them or let them be as a part of our records. So first, superseded drafts of working papers and financial statements. So when we conduct audit, when you are doing certain checks, you do certain analysis and you feel that okay, this particular component of the P&L is okay. Your manager comes into play and he says that no, you know what, analysis has to be improved further, or this checklist has a missing component. So you make a second version and then you rectify that and then you tick off that profit and loss item. Now you have a version 1 which has incomplete working, and you have a version 2 which was pointed out by a manager and it has a complete working. So you need to keep only version 2, not version 1. So when you say about superseded drafts of working papers and financial statements, you don't have to keep all versions in place. Only the version wherein the final working is there. If you feel that there's certain note which will help you to recall that how did you come to this conclusion, that you can mention there. But you don't have to keep all the drafts, because as though you'll have to become a lot of paperwork and a lot of storage space that will go into waste. Notes which reflect incompleteness. Sometimes we scribble or we just make certain notes for our references, but they do not qualify as audit evidence because they are not final in nature. So in this case, these notes will also not form part of the audit documentation. Preliminary thinking. When we are planning the audit, you try to think, you try to conclude that whether these checks should be forming part of the checklist or not, whether we need to conduct this particular audit steps. Or let's talk about the team composition. When you're planning that, okay, this is my audit timeline, these many members will be in play. Now, this is part of all preliminary thinking. How did you come up to the finalization of the audit team is not important. Only the audit team is important. How did I conclude? What were the man-hours there? So this kind of working, if you've done, well and good, but you need not keep it as a part of your audit papers, and it will not qualify as an audit documentation. Oral explanation by the auditor. So sometimes what happens is that there are certain instructions that we give to our audit team for the good conduct of audit, or something which is internal to the audit firm. But this is not a part of the audit evidence because it does not relate to the audit of the financial statements. These are just mere instructions or mere commands that are given to the audit team so that the audit is done as per the audit plan. So that also need not be covered under audit documentation. Previous copies of documents corrected for typographical errors and other errors. This is similar to the first point that you sought some documentation from the management, you got them as audit evidences. Then you saw that, okay, maybe in a set of 10 papers, only 2 papers were relevant to you. So you kept the 2 pages and the rest of the 8 were discarded. Or there was some typographical error in the documentation that was received from the management. So you asked for a better copy or legible copy of the documentation. So you need not keep the copy wherein the ink was not visible or where it was not properly scanned. These are all waste documents. So I, as an audit practice, what I do is when we do audit, we make a folder by the name of waste papers. We don't delete them there and then, because sometimes you might want to refer back or you might not keep a copy of the same. And I tell my team and myself also to, whatever documentation is not relevant or which will not form part of these points, that are not audit documentation, I keep on, placing them there in the waste folder. And when I feel that at the end of the audit, or maybe when I get time, I sit down again and go through the waste folder again. And I see, okay, what are the documents that I can, permanently delete them, or need not, I will not require them in the future. There are chances where in the waste folder also I get some documents which may have audit relevance, because during the course of audit there is so much pressure. Sometimes there's resource crunch, sometimes there's a timeline, that you need to adhere to. So you may or may not be able to go through each and every document that is there. So as a good practice and for easy conduct of audit, always park them into waste folder, and then you can move them back to the main folder and permanently delete the other documents which may or may not be relevant to you. Duplicates of documents. This has been covered in the previous copies also, that sometimes you repeat the audit point, or the management sends you the audit documentation late. So you might have sorted physically from the team and then they mail it to you as well. So as a instruction to your audit team, you've told your article assistant that, okay, whatever document you get, you save it here, you name it, you label it properly. But when there are repeat documents available, or there could be similar documents that you need to remove, and no need to keep bulky documents unnecessarily, and that repeat document will also not be considered as audit documentation. So I'm repeating again, this is not an exhaustive list. This is some few examples of documents which are not considered as audit documentation. The idea of giving this slide here is that when you maintain audit documentation, you should know that what kind of documents I need to maintain, what kind of documents I might be required to share with the stakeholders, what kind of information I need to give to my, peer reviewers. And when you remove this kind of documentation, it becomes easier for you to focus on the audit also and maintain an audit documentation accordingly. Review notes. Again, this is very much similar to, scribbling or any notes which are rough in nature, rough drafts basically. Okay, audit documentation. Now, I have defined why is audit documentation important. I've also defined that what is the nature of audit documentation, like what all factors you need to consider. Now, these are the types of audit documentation that I need to maintain, so that I, as an auditor, can prove that, okay, I have conducted the audit in the best possible way manner, because I can prove you I did these steps, or I can prove you that I have these documentation available uh, for your review. So first is the documentation regarding understanding the entity. So, for example, if you're auditing a company, a private limited company, you need to have the certificate of incorporation and the MOA, AOA in place. So you know that, okay, I'm sure this company is a private limited company. I've gone through their objects. I know what kind of business they are into, what kind of product or services they are dealing with. You have the annual report handy. And if you're a first-time auditor, you also have the previous audited financial statements. So these kind of documentation will fall under this point of understanding the entity. Then documentation regarding time and cost details. Now this talks about your timesheet. Now, if you are an audit firm which has a timesheet concept in place wherein your team plots in the hours and then you do the costing. So this kind of documentation it comes handy when you need to prove that why are you, charging certain kind of fees to your management, and for your own profit calculation as well. So this kind of documentation needs to be in place, and it's very important from the audit documentation point of view. Audit program. Audit program is the backbone of the entire audit. Right from the start of the engagement letter, team composition, what kind of work has been allocated to which team, audit timeline with different milestones, and the audit report. All of this forms part of the audit program. And audit program in itself is an audit documentation. And in audit program itself, you define what kind of audit evidences or what kind of audit documentation I need to sort at different stages of the audit, whom to interact with, who is the management there, who is the SPOC. Everything is covered under audit program, and it is a very important audit documentation needs to be in place. If any of the firm, of any of the attendees here have got their peer review done, the first question that the audit peer reviewer asks is for an audit program. Risk assessment. What kind of documentation we have in place to assess the risk? This becomes very important, especially with the paragraph on the internal financial controls in the auditor's report. So I need to prove that, okay, we have done the risk assessment, and as per us, you categorize the organization as highly risky, medium risky, or low risky, and what all factors have been there. Then list of samples and basis of selection. When you do the audit, right, you obviously sampling methodology is part of the audit evidence. And then you define that whether I'm going for random sampling, whether I'm going for, stratified sampling, and what methodology have I used, what kind of logic have I used to define the sample buckets, and how have I selected the profit and loss items or the balance sheet items or particular ledgers or particular parties, to classify them. So if I have, you don't have to like give a very detailed way of selection, but I need to have some logic or some analogy to define that why have I selected this particular ledger and how have I derived that, okay, I need to check 5 samples and so on and so forth. So I need documentation for to prove the sampling methodology as well, so as to come to the conclusion that the audit has been conducted properly and the financial statements are free from material misstatement. Okay, so in my previous slide, I had talked about this point of risk assessment. And I think risk assessment is one part which we as auditors of, especially who are small and medium practitioners, we kind of avoid. And sometimes we do not have proper guidance and we don't know how to, conduct risk assessment. So that's why I included these two slides for the sake of benefit of the attendees. So I have classified the risks into 2 categories. So first we will refer to financial risks. And I will just give you a few examples to determine if the financial risk is there or not in an organization. Again, I'm reiterating, risk assessment's primary responsibility lies with the management. It is their prerogative. We will only come and check whether the risk assessment had taken place, if it was there, whether it was done properly or not, depending upon these indicators. So first, let's have a look at the few indicators of which relate to the financial risks. So, maturing borrowings without prospective renewals. Sometimes what happens is if the organization has sought loans from a third party and every year, because loans can be of 2 types, there are term loans, there are working capital assistance, and working capital assistance is something which year on year, if the organization is growing, it would require. And suddenly, if the banks, they object or they do not renew their, working capital limits, then that is a sign of a financial risk. And you need to understand from the management that why was the loan not renewed if your company is growing or, maybe getting new contracts, because how are you going to fund that kind of operation? Application filed against corporate debtor in NCLT. Now, depending upon what is the dependence of the organization with that particular debtor, if you have filed an application against, that means it puts a question mark on the recoverability of the dues from that particular debtor. And when you go to NCLT, it means the matters are quite serious, and this will also result in increasing legal costs. So first of all, is that debtor so big that it can have a direct impact on the operations of the organization? And is the company in a position to bear that kind of legal risk in terms of cost, time? You can also, get in touch with the legal expert who is handling this particular legal matter or the CS who is looking at the NCLT matter. So we need to understand if the financial risk is actually in place or not. This is just an indicator. Negative net worth. Obviously, if net worth of the company is negative, that means it is accumulating losses. It is not making profits, and it may pose a big question mark on the going concern of the organization. So we need to sit with the management and understand that why is net worth negative? How are they foreseeing their operation in the future? Are they going to recover at some point of time or not? If the result of all these questions is negative, then you need to modify your auditor report and modify your audit procedures accordingly so that you can cover yourself. Recurring operating losses. See, having losses is not an issue, especially if you are auditing a startup organization, because in the beginning, most of startup organizations, they take time to break even. They could be, in burning cash. But you need to understand from the management what is their plan to deal with these recurring operating losses. Are they foreseeing, what is their projection basically? If I talk about startups in particularity, because they need to raise funds from the investors. And when you raise funds from the investor, they need to submit their projections that, okay, in the first 5 years, you'll be incurring losses. In the next 5 years, you'll be getting your money back. So seek that report from the management, sit down with them and understand that, okay, what is your plan for the upcoming future? How are you going to repay these losses? Or is there any plan to recover these losses in the future? Sometimes they just start an organization, the losses are taking place again and again, and they're not bothered about it. That becomes a big red flag for you as an auditor. And then you amend your audit procedures accordingly. You need to give certain points. Now, you may or may not modify your report, but it's obviously advisable to give an emphasis and matter paragraph wherein you mention that, okay, in so and so years, we have gone through the project report and the operating losses will be in place for so and so years. They foresee that the losses may or may not be after 5 years. But you need to have some basis. And this is a big red flag. And this also, if it is repeating again and again, and the management has no plan to, cover these losses, this is a big financial risk for the auditor. Arrangement with creditors for reduction of payment. In this particular stage, the management is trying to negotiate their payment terms with the creditor. And when you negotiate the payment terms, that means there are some working capital issues with the organization, and the management is not able to fund that working capital deficit, or they're not able to manage it properly. So again, understand from the management what is the reason, and are they going to rectify it? Is there some way? I mean, because again, this is primarily the management's responsibility is to sort out their working capital mess. If they're not able to do that, that becomes a big financial risk. And in the risk assessment, you as an auditor can put a red flag and understand what should you do to, encounter this kind of a problem. Working capital deficiencies. Now, working capital, obviously, it's very important for the smooth operation of an organization. And if the working capital is negative, you, first of all, in this case, what you can do is, uh, in the past 2, 3 years, it has become important for the mandatory for the companies to report those 12 key financial ratios as a part of their financial statements. And the first ratio that they need to report is the current ratio. So current ratio is directly related to the working capital deficiency. And you understand why is it, adverse. If it is adverse, because the management again has to work on it. And what steps the management is taking? Is it going to seek any working capital assistance, or do they have any plan in place? Accordingly, you amend your audit procedures and you give the opinion and auditor report. Disposal of substantial assets. If the company of the organization is disposing of substantial assets, that means it's a huge financial risk. That means it poses a big question mark on their going concernability. They are not sure whether they're able to, continue. And you need to understand why are they disposing substantial assets if they wish to continue as an organization, because that is not an ideal way of raising funds to run an organization. You can seek loans, you can invite investors to infuse capital, but selling of the asset gives a very negative message, and becomes a very important part of your risk assessment. Inability to pay the creditors on due dates. So I've already defined this under this point, that when you're able to meet your payment terms, this can invite, interest and penalties from the creditor. This can also tarnish your image in the market, that, so and so company does not pay the creditors on time, and then we would not like to work with them. Also, it has an adverse reporting in the GST also, because you are required to pay off your creditors in 180 days, or else your input tax credit gets reversed. So these kind of indicators, they also they fall under financial risks. And if this is in place, again, reason from the management, seek written representation from them. Why are they not paying the creditors on due dates, and what are they going to do about it? And then you amend your audit procedures accordingly. Default on loans or similar agreements. When you do not pay the interest and the principal component of your loans in a timely manner, these banks also blacklist you as an organization because they don't want NPAs, right? And then there could be a situation where in the future the banks will not provide you with the financial assistance, and this will have a direct impact on running of your operations. So when you review the loan component of the balance sheet items, that is the basic check that you do. You ask for an EMI chart, you see whether the payments are being made timely or not, accounting is doing properly or not. And in case of default of repayment, you question them, and then it becomes a part of your risk assessment. Negative cash flows from business activities. Negative cash flow from business activities means that your operations are not running properly. You're not being able to meet your expenses, and you're not generating enough revenue. So this in itself is a big financial red flag. And you amend your risk assessment procedure accordingly. You ask from the management. You understand why is it happening. This could be temporary and it may be rectified later, but you need to have solid evidence in place to prove that. Excessive or obsolete stock. Excessive or obsolete stock signifies working capital blockage. Sometimes what happens is that due to technology changes or due to a fall in demand for a certain product, you have excessive stock in place. You're not able to liquidate it, and you don't understand what to do with it. So when you look at the stock records, when you look at what is the you in order to test this, the auditor needs to ask for a non-moving or a slow-moving stock report. And and you need to derive the percentage of this non and slow-moving stock on overall stock and understand that why is it still in place? What is the management doing about it? Do you plan to discontinue this particular product? And how are you going to, sell it? You can sell it at salvage value also, because sometimes when you're not able to sell the stock at cost, you do it at realizable value. It could be negative realizable value, but it should not be lying idle, because it's not just a working capital blockage. You're also incurring storage cost, carrying cost, and these are hidden charges, which is, negatively impacting your financial performance. So this also becomes a part of your financial risk assessment. SIC entity under any statutory definition. So SIC companies have been defined under the applicable provision of the Companies Act. And if your auditee falls under this definition, your audit procedures will change entirely, because the risk component is very high when you audit such an organization. Debt restructuring. If the company or the organization is undergoing debt restructuring, so debt restructuring is not a negative component. It's actually a good thing to, sit down and revise and understand that the interest cost that you're incurring, to not to reduce that, you go for debt restructuring. But if debt restructuring is a regular feature, and if the management is not able to justify that why have they undergone debt restructuring, you can obviously compare the borrowers that were reflecting in the previous financial year and the borrowers that are reflecting now. What are the source of finances that the companies are using? And you will get to know that a debt restructuring has been done. So if a justifiable reason is given by the management, then it is good to go. But if you're not satisfied as an auditor that why they have taken up debt restructuring, and you feel that this debt restructuring is not going to reduce the interest component, or the terms are very loose, or it can restrict the financial performance of the organization, that becomes a part of your risk assessment, and it becomes a red flag financial risk, and you can change your audit procedure accordingly, and use appropriate terminology in your audit report to cover yourself. Unable to obtain finance of new product development or essential investment. This is very much applicable to startups of these era, because when they come up with an idea, when they come up with their minimum viable product, and in spite of being working on in years, they're not able to obtain any funding properly, or investors do not see any future in this particular product. And if you are appointed as an auditor of this company, again, understand what is the plan, how are they going to, make it commercially viable, what kind of investors they are approaching, and whether they foresee this company to become profitable in the future or not. All these components need to be understood from the management. And again, depending upon what kind of audit evidence you get in place, you carry out a risk assessment of this particular aspect and then modify your audit procedures. Reliance on short-term borrowings to finance long-term assets. Now, this particular part is one of the clauses of CARO 2020. So ideally, when you take short-term borrowings, it is present there to, meet your working capital requirements. And short-term borrowings have less stringent, laws, and the interest rate is lower than in case of a term or a long-term borrowing. So many organizations, they cunningly use their short-term finances to fund their long-term assets. For example, they've acquired a building, or they've acquired a car, or, because they know when they go and they ask for assistance to fund a construction of a building, the terms will be absolutely different. It will be more stringent. They might have to mortgage their property, and the interest rate will be very high. But as per law, it is not allowed because you are basically duping the bank. You are telling them that, okay, I'm using short-term assistance. I'll give you the stock statements and the working capital requirements. So this you need to check. You need to understand the application of the loans that is being applied, and not only it becomes a part of a financial risk assessment, also you need to report on this in one of the clauses of the CARO 2020 if it is applicable to the company that you're auditing. Adverse key financial ratios. So I'd already mentioned when I was discussing the different financial risks that when the format of the schedule, so we came up with the Schedule 3, which deals with the financial statement reporting as per the Companies Act 2013. So they had introduced 12 key financial ratios, which is mandatorily required to be reported by all the companies. And that becomes a base of the negativity if there's any adverse key financial ratio. In fact, the reporting of the key financial ratios was taken one step ahead, wherein the management is required to report the reason of the variance in case the variance exceeds 25%. When I talk about variance, I'm saying when you compare the ratio of the previous year to the current financial year. And if the variation reason exceeds 25%, then you have to give the reason for the variance. So this becomes a very important data point for the auditor to carry out the risk assessment, because these are some ratios which are generally analyzed by any of the stakeholders, whether it be investors or the bankers or any other stakeholder. So if these key financial ratios are adverse and the variance exceeds 25%, and the management has given the justification. So again, understand if justification is good enough. If it is not, you question back to the management. And if you feel it might have an adverse impact on the audit report, please go ahead and report the same. So I think with this, we come to the end of the financial risk assessment. Now, I had said that there are two kinds of risk assessment that take place. First was financial risk, which I've covered in quite detail in the previous slide. Now let's talk about the operational risks. So operational risk assessment is again ideally the responsibility of the management, and it does not have any direct impact on the financial misreporting, if any. But operational risk assessment helps you understand that whether the company is in a position to continue as a going concern or not, and it helps you with the proper audit documentation of the risk assessment component of the audit documentation. So I will share a few examples. Now, if you are auditing manufacturing entities, now these factories, they have their labor unions. And suddenly, in news you hear that the work has been stopped or the labor union has gone on protests. That becomes a very big red flag, and you need to understand again, why is it happening? What kind of impact it's going to have on the organization? You get in touch with the legal counsel who deals with their employee-related laws and see if the compliances are in place. You understand if at some point, the union files a case against the organization, what steps the organization needs to take place, whether you need to provide for the same in the financial statements or there will be contingent liability. So all these factors come into place. Now, I am trying to give you the financial aspects that may be derived from the operational aspects. This is an operational issue that the work stoppage is there, but it has a direct impact. That is why operational implementation. Management intentions to liquidate the entity or cease operations. Yeah. Rashi, am I audible? I hope my video and my PPT is visible.
Yeah, it's visible.
Okay, great. Just a second. Yes. So next point was the management intentions to liquidate the seized or entity seized the operations. Now this is a very classic example wherein due to some issues the organization intends to close or shut down the operations, and this puts a big question mark on the going concern. So when the going concern itself is impacted, then obviously it becomes a financial as well as operational risk, and then you see if the management has prepared the financial statement as per the going concern assumption, whether they've used it or not. And ideally, it should be made on liquidation basis. And they have given adequate information in the notes to accounts as per, applicable accounting standards. And then you need to report in the management. I think in this case, the report will be modified and you give your opinion accordingly. Loss of a key management or staff. Sometimes in an organization, it is heavily dependent upon a particular employee or a particular key management person, a KMP passes away or he or she leaves the organization, then the strategic help that that particular KMP was provided to the organization is lost. And when that's there, then the organization does not know which direction to go into, and this can have a direct impact on the operation and obviously on the financials. So if a situation like this comes into place, again, understand from the management how are they going to replace that particular person or what are steps they're going to take to, uh, cover the losses which the company may incur on account of the loss of such key management person or staff. Excessive reliance on the success of a new product. This is again very much relevant to the startups of these times. Sometimes, with so much technology advancement happening, you come up with a new product and you also have a projection in place. You have the proper, timeline in place that, okay, for the first 5 years, it'll take us to break even. And then in so and so year, we will sell so many units. We are having so many investors in place. And this is the only product you're relying on. Now, in initial years, you can obviously, as an auditor, rely upon that project report. You can tell year on year that, okay, the assessment is being done by the management and they are sure this product will become successful. But again, professional skepticism has to be kept in place. I need to understand that how are they going to, come up with the success of the product. If that particular timeline has been crossed, again, you go back, you question them, you seek the new or the modified projection report and see how are they going to determine if the success of the product is there in place or not. Or if they are not able to determine the success of the product, have they come up with an alternative product? Or do they have any other product lines in place so as to cover for the losses that is being incurred due to this particular product in place? If not, that means they are excessively reliant upon that product success, which is not coming, which is not there, and you as an auditor cannot predict the same. So again, you change your audit procedures, you go through your audit documentation, and then seek assistance from the management to prove that this particular product will be successful or not. Loss of a major market or a principal supplier. Sometimes what happens is that you are heavily dependent upon a supplier and your business is going smoothly. Now, suddenly that supplier becomes, he files for bankruptcy due to his fault. And because that particular supplier is bankrupt, your supply gets impacted, your operations get impacted. So you need to have a contingency plan. By you, I mean the management. If the management has a contingency plan in place to replace that particular supplier, and so that it can bring back its operations to the original pace. And also, when you see that the management is heavily reliant upon supplier, you need to understand the management. How do they foresee any risk in the future? Do they have any alternative, vendors in panel that in case this particular vendor does not turn up or becomes bankrupt, whether can I rely upon the other vendors or not for that particular quality, whether the quality of the supply which the bankrupt supplier was providing is the same or not. So all these factors the management has to consider. But I, as an auditor, also need to understand that if they have done this kind of operational risk assessment, if yes, and I will obtain, proper documentation from the management and make it a part of my audit documentation, conduct my audit accordingly and give the reporting. Pending legal proceedings, which might jeopardize an entity's ability to operate. Sometimes you hear in news there is a trademark dispute going on, or sometimes a very big customer or supplier has filed a suit against the organization, and you then need to seek help from the legal expert who's handling this case or the legal team which the management has, and what is the probability of them winning, or how many years it's going to take place, is it going to have any direct impact on the operations. Sometimes what happens is, as a part of the legal proceedings, the bank account of the organization is frozen because the assets are frozen. So in this case, the operations are jeopardized and it obviously has a huge negative impact on the financial performance. So how is the company going to recuperate from that? Does the management has any plan in place? And if you as an auditor feel you use the professional skepticism, and sometimes the management tries to fool you also that okay, nee, everything is normal, nothing is there. But you take assistance from the external parties and then basis, because you have proper audit documentation to prove that the management is fooling you. And in spite of their operations being jeopardized, they are trying to paint a rosy picture. So then it's because you have the audit documentation to prove that the operations are going to be jeopardized, the legal suit is big, and there is no provision that has been done by the management, you can obviously amend your audit procedures and give the audit reporting in accordance with that particular aspect. Substantial dependence on the success of a particular project or a particular asset. This is very much similar to the excess reliance on the success of new product. I've already defined that. Technical developments which render a key product obsolete. A very classic example of this case is for someone who was dealing in BlackBerry, way back, let's say a decade ago. BlackBerry was a huge thing then. And suddenly smartphones came into picture and then BlackBerry was nowhere in the market scene. So a classic example. Now, if a person was exclusively trading into BlackBerry, he's out of business. If he's out of business, his going is impaired. So is he adopting the new technology soon? Or how is he going to deal with it? This kind of assessment has to be done by the management as well as the auditor. Non-compliance with capital or statutory requirements. You, as an auditor, there's a SA 250 which talks about considerations of key laws and regulations. And in this, while carrying out, like as a part of the compliance of that particular essay, the auditor needs to understand the compliance framework to see what kind of compliances are applicable to the organization and the compliance environment, that I know these compliances are there in place, but whether the management is following those, is compliant enough, whether they are regular in, being compliant, being depositing the dues or not. So depending how the compliance framework and the compliance environment of the organization is, you carry out your risk assessment and amend your audit procedures and report in the auditor's report. Emergence of a highly successful competitor. Sometimes it happens is that you had a monopoly on a particular product and suddenly out of nowhere, a new competitor comes into place and takes away your entire market share. What is your contingency plan? How are you going to deal with it? This also becomes a part of a risk assessment. Loss of a key franchise, license or patent. Because you're heavily dependent on your profits for the particular franchisee or a patent, it could be like a trademark dispute and you lost it. So that becomes a part of your risk assessment and then you carry your audit accordingly. Changes in or establishment of new legislation or government policy. A classic example of this would be that sometimes, let's talk about the ban of single-use plastic. Up till there was a time where single-use plastic was very much in, and almost all these small kirana shops to big organizations, they used to use single-use plastic. And because it was hazardous for our environment, the government has banned single-use plastic in particular states. Someone who's exclusively into manufacturing and trading of single-use plastic, his business has gone and they need to come up with a contingency plan. So this becomes a huge operational risk. So you question on the management, do you have any alternative product in place? If not, how are you going to deal with it? Are you going to continue with the business or not? So these kind of questions should be posed and become a part of operational risk assessment, amend your audit procedures and report in the auditor's report. So I think, okay. So with this, we have understood the risk assessment part of the audit documentation. And the reason I emphasized on this was because most of the auditors are not aware how to carry it, what kind of factors should be in place. It's not a very elaborate documentation, but you need to have these key factors in place. And again, I'm reiterating, this is not an exhaustive list, it's only illustrative, but it more or less covers most of the risks that the organization faces. Now, coming back to the type of audit documentations, we have covered all 5 of these, yes. And okay, let's talk about the significant matters. So what are significant matters? These are those matters which give rise to significant risks, which are the risk of fraud, risk related to economic or regulatory changes. I've already given an example, which is ban of single-use plastic. Significant transactions with related parties. For example, transactions which do not take place at the arm's length price or ALP. Matters giving a significant risk also include transaction outside the normal course of business. So if, like I said, when you audit an organization or audit a company, you go through the objects that are defined in the MOA and the AOA. So you know what kind of product or service line this particular organization is dealing with. But out of the blue, suddenly they pick up a new business line. So just get the justification of the same. And if you feel it's in a normal course of business, then there is no risk associated to it. But it's not, then you need to again modify your risk assessment and include this as a part of significant matters. So I've given examples like transaction with the offshore entities in jurisdiction with weak corporate laws like tax havens, Malta, Cayman Islands, etc. Sale transaction with unusually large discount or returns, corporate restructuring or acquisition. So these are certain transactions which are outside the normal course of business of the organization. Leasing premises without any consideration. Why would anyone do that, right? Then circumstances causing difficulty in applying audit procedures. This basically becomes a part of the limitation of scope of audit. Finding resulting in modification of audit opinion. Now, modification of audit opinion, when does that happen? When the financial statements are materially misstated or you're unable to obtain sufficient appropriate audit evidence. So I'm just covering some part of the SE 705 here for sake of everyone's benefit. Okay. Now, continuing with the audit documentation, in addition to the previous points, we have these also. So I talked about significant matters. So in order to maintain significant matters, it has to be some correspondence. The best way to correspond or communicate with your auditee is through mails. WhatsApp are also in place, but WhatsApp have disappearing messages, so that can be, it can be a little controversial. So obviously, that the fact that you have conveyed the information regarding significant matters, or you've conveyed to the management, I need this information in place, I need to prove that. अब मैनेजमेंट ने दिया या नहीं दिया वो उनका प्रेरोगेटिव है, बट लेकिन आपको तो करना चाहिए, सो इसके लिए आपका प्रूफ होना चाहिए. Communication to those charged with governance. So we have the management representation letter, popularly known as MRL. MRL format is also given in, I think, SA 230. And again, please use CAGPT. They will give you amazing MRLs for different organizations, for different applications. Due to paucity of time, I may not be able to share the format here. I'll see towards the end. If I have some time, I'll go through the format also. Audit reporting, obviously, it's the outcome of any audit, and you need to refer to SA 700, 701, 705 for audit reporting. Abstract or copies of entities records. Now, these are certain components which are important. So you take duplicates, you take, photocopies of these papers, which form part of your audit documentation. Basis of conclusion. How did you come to the conclusion that the financial statements are free from material misstatements, whether the checklist was properly done or not, or if you have any emphasis on matter paragraph, why did you report a matter there or not? And if you have qualified the report, why did you do that? So all these conclusions need to be justified, for which you need to have audit documentation. Engagement quality control review. So in case your engagement has undergone quality control review, so again, sit with your reviewer and see what kind of documentation you need to maintain and submit there, and prepare a separate file for that. So we had a firm recently peer reviewed. So I have made certain formats. I have made certain, folders there, so that in future, I think it'll happen every 3 to 5 years. So I will just refer back to that particular documentation. So it becomes easier for me to, get my peer review done. I don't have to start from scratch again. Checklist, compliance with the AS and SA. This is something again which I think we as a small and medium practitioners do not have in place. We do audit in the most random way possible. And there are now audit tools in the market which help you, navigate your way through the SAs and the AS. And your team can put their points there, upload the evidences, and to ensure that you're compliant with the SA and AS. It helps you with the quality control review and the peer review as well. Letters of confirmation and representation. I've already given reference to SA 580, and it has detail on what all written representation and confirmation need to seek from the management. Assessment of reliance placed on other auditor experts. So as a part of my audit engagement, I can get in touch with the other auditors. Well, for example, you're taking, maybe a joint audit, or I can take help from the experts. I think it's SA 601, if I'm not wrong, and SA 610. So you refer to that, and you can also seek reports from them. They seek their help, and that also becomes a part of your audit documentation. Okay, so I have given a format of a letter of confirmation format. I think I'll come back to the slide later because I have more content to cover. So this is just a format. Again, it's easily available in the essay. Again, reconstructing an MRL. So these are some components of the MRL. Very quickly, I will tell you. Obviously, you need to have the name and address of the auditor, subject, introduction, that we are conducting the audit of so-and-so organization. Management responsibilities is the same as the engagement letter, scope of audit. Then we will talk about in the management representation letter. In case of balance sheet items, I need so and so requirements. In case of profit and loss item, I have so and so requirements. General points, so and so points, name and signature. This format is easily available on CAGPT. You can download it from there. Now, I think how much time do I have? Do I have 10-15 minutes, Rashi?
Yeah, you do have 10 minutes.
Okay, so now I wanted to jump to this part of my slide deck because herein I have given I have broken down the components of balance sheet and P&L, and I'm trying to tell here that these parts should be properly covered in the management representation letter. So let's talk about few of the balance sheet items. I thought it was important to cover this because this helps you establish the content of the ideal management representation letter, which is a very, very important audit evidence. So let's talk about the plant, property, and equipment (PPE) of the balance sheet item. So what kind of language or what kind of information should form part of the MRL regarding PPE? So first, all the items under PPE are held in the name of the company and registered in our name wherever so required under any law to be registered. Now, this is also an additional regulatory requirement as per Schedule 3 of the Companies Act. So you can use this format wherein the management is required to give the details of immovable properties whose title deeds are not held in the name of the company in the format given below. By the way, this forms part of the financial statements. It's there in the notes it's there in the financial statements. And you need to check with the management that they are giving this there and replicate the same in the management representation letter. So this is how both of these components become linked. So in this table, you give what is the line of the balance sheet item, description of the property, carrying value, title deeds held in the name of. So this is only negative reporting. This is only applicable wherein the immovable properties are not held in the name of the company. So for this, you need to have the title deeds in the name of the company handy. That becomes a part of our documentation. And whether title deed holder is a promoter, director, relative, promoter, etc. Property held since which date? Reason for not being held in the name of the company. Next. Then I have taken, some help from the CARO, wherein I have mentioned that we are maintaining proper records of PPE, and I have a policy to physically verify the PPE. What is the documentation of physical verification? You have a PV report, by which PPE are verified in a phased manner over a period of 3 years, and no discrepancy was noticed in the verification in the year. This particular point is also form part of the clause of the CARO 2020. All the items in the PPE and intangible assets are identified, recognized, accounted, depreciated, de-recognized, and disposed of according to Schedule 3 and applicable accounting standards, which is AS10 and AS26. None of the expenditure which do not meet the criteria as given in AS10 is recognized as PPE. We are following cost model for its entire class of PPE. None of the PPE have been revalued during the year. So this language is being used when I say we, by we mean the management. So the management is declaring and saying that, okay, we are being compliant in so and so manner. It's our responsibility and we are doing the same. So that we as auditors are covered here. So we can always go back to the MRL and say that, listen, you had signed off this management representation letter. That means all of this was your responsibility. My responsibility is only to check the completeness and accuracy of the same. Continuing with PPE, all items under PPE and intangible assets are depreciated and amortized according to Schedule 2 of the Companies Act 2013, read with the applicable standard, which is AS10 and AS26. None of the self-generated intangible assets like goodwill is recognized during the year. They are amortized over the useful life of the asset as per AS26. CWIP, capital work in progress, related to PPE as well as intangible assets under development have been correctly disclosed in financial statements along with its aging as per the applicable financial reporting standards. So herein I have very smartly, shifted the onus onto the management, and I've told them that you get this done. I will just review it. This is not the auditor's responsibility. That is why MRL is very important. Moving on to the next component of the balance sheet, which is investments. Investments are classified and accounted appropriately in accordance with Schedule 3 and AS13. Current investments, as appearing in balance sheet, consist of only such investments which are readily realizable and are intended to be held for not more than 1 year. That's why they are reported into current investments head from the respective dates. All other investments in the balance sheet are shown under non-current investments. They are valued at lower of cost and fair value. They have been shown at cost, except that any diminution in their value being other than temporary has been provided in ascertaining the carrying amount. There are no investments held by the company in the company which is struck off by the register. So this is an additional regulatory requirement as per Schedule 3. They are produced before you for physical verification. So you can always ask for the DMAT certificates in physical format. So again, through this point, I am trying to cover my audit documentation bit. I am telling them that management will share, whether in DMAT form or physical format, the evidences of the investments to prove that they belong to the entity and do not include investments held on behalf of any other person. No investments were made in contravention of Section 186. So I'm trying to look at the legal aspect of the investments as well here. It has not complied with the number of layers prescribed under Clause 87 of Section 2. And there's a format. This is also defined under an additional regulatory requirements of the Companies Act. So you need to give this format. Now, the management may or may not fill it depending upon the applicability. Next component of balance sheet is trade receivables. So it is classified as receivable only if the amount due on account of goods sold or services rendered in normal respect of course of business, not way out the normal course of business. They are expected to be realized within 12 months after the reporting date. That's why they are classified as current. If not, they'll be classified as non-current. Adequate provisions have been made for doubtful receivables and proper disclosure have been made as per balance sheet required by AS4. They are not disputed unless otherwise stated in financial statements. Proper aging has been done. There's an aging format which has been defined in the additional regulatory requirement. And it is an important part of the and mandatory part of the financial statements. So aging has to be there. No unrecorded trade receivables as at the year end are present. Coming on to inventories, proper record of movement of inventories is there. There's a process of physical verification of inventory on quarterly basis. If your company requires CARO 2020 compliance, physical verification point is covered there as well. There was no material discrepancy found. The inventories are owned by the entity, whether they're on different locations. They have been recorded, including goods sent on transit. No slow-moving, excess, damage, or obsolete inventories which require provisioning are present. Always asks for report for slow-moving, excess, damage, non-moving, obsolete inventories. If the management says there is no slow-moving there, your job is done there. You are no longer required to divulge further. There was no stock in transit which was not according to the books. We have valued inventory at the year end in accordance with AS2 and you get the classification. Again, this is also very important. The inventory component in the balance sheet has to be classified in this manner: the raw material, work in progress, finished goods, stock in trade, stores, parts, and loose tools. Next component, loans and advances. They are made by the company, have not been shown as deposits. There were no debts which is due by the director or the officer of the company. And the company has not granted any loan or advance to promoters, direct KMCs, and related parties. Cash. Cash has been physically verified and no discrepancy was found. Ask for the report for physical verification of cash. Share capital. If they are not listed entity, then there is no application for allotment of securities, no major change in shareholding. The details of shareholding, having more than 5% shareholding, is reported separately in notes to accounts of the financial statements. And you also ask for the list of promoters of the company, which is a part of the financial statements. Borrowings. Proper classification as per Schedule 3. Security, if any has been offered, the charge has been registered in the MCA site or not. No charge or satisfaction charge is pending as on date of balance sheet date. In case there is some pendency, then you ask for this particular table. You can always cross-verify them from the MCA site. Security offered are owned by the entity and they represent the values set in the loan documents. Always ask for loan documentation. Current maturities of long-term loans have been classified as current. No default in repayment of loans. The company has not accepted a loan in contravention of Section 185. Term loans have been applied for the purpose for which they were raised. Advances received from customers represent some received in normal course of business, either in case of supply of goods or provision service and not in the nature of loans. If they have borrowing from financial statements, then on the basis of security, then in case of that, they need to quarterly file their stock statements or debtor statement depending upon the sanction letter terms. There's a table format again given for the loan component of the financial statement that is given in the financial statement itself. Trade payables. The classification of trade payable is done only when the amount is due in the normal course of business. No unrecorded trade payables have been there. Very important, trade payables to the MSME. Now, this is a new compliance that has come into place, especially when you talk about Section 43BH of the Income Tax Act. I will not go into detail, but that's how both of these points get related there. There is no trade payable due to the struck off companies. Other liabilities and provisions, I'll skip that. Profit and loss matters. We follow mercantile system of accounting, and all income and expenses, they are accounted for the books related to this financial year only. Prior period items have been disclosed separately. Income accrued up to balance sheet date have been recognized. AS9 has been followed here. Recorded revenue rose of transaction which took place in relevant period pertinent to the organization. No unrecorded end revenue of the entity has been placed. Expenses are properly recorded. There are no dues payable to employees. Here I am talking about the employee-related compliances. Then no expenses of personal nature or capital nature are charged to the P&L account. General, I think I'll skip it for the paucity of time. I wanted to cover, okay. Okay. So in this particular part of the slide deck, I have covered different essays and what kind of documentation is present there. So very quickly, I'll take 2 minutes. Essay 240. We have already covered some of these broad points in the slide deck, but I have classified them essay-wise. So here you need to check the risk assessment part. I've covered in way too detail regarding fraud and operational risk. Then response to assessed risk communication, fraud and revenue recognition. So all this can be covered here. Essay 250 talked about the compliance environment. So if there's any non-compliance or discussion, you obtain, the copies of records, minutes of the meetings. You have your checklists and tables to see if the company is legally compliant or not. In fact, there's a separate disclosure required under CLARO 2020 as well. Then SC 265, communicating deficiency in internal control. You take written communication from the management with this regard. SC 300, which is very important, planning and audit financial statements. I will not go into detail. It talks about the audit strategy, the audit program, that how is the audit will be conducted, team composition, any changes, proper timeline, proper milestones, etc. SC 315, identifying and assessing risk of material misstatement. Again, what kind of discussion took place? You note down the minutes of meeting, you understand the control environment, you understand the risk assessment, right? And what is documentation that you need to justify that you have complied with SC 315 or not. SC 320 talks about materiality. How did you come to determine that particular check or particular audit procedure is material or not? And whether I can leave it or not, you need to justify that. 330, auditors respond to assess risks. That whatever risk you've identified as part of risk assessment, how you deal with them. 540 is accounting estimates. If the management has made certain accounting estimates, understand the proper documentation, whether it's appropriate with respect to the financial reporting or not. How did you come to that conclusion? That documentation needs to be maintained here. 550 related parties. You need to comply with AS18, like the name, relationships, transactions, whether at ALP or not, and change in name and nature related parties. Going concern, I've covered in huge detail. Other auditor work, if you're using, sort the report from them, take their, audit reports. This is only applicable in case when you're doing a joint audit. 610, using the work of internal auditor. If there are internal audit report available in place, please use them. They can act as great audit evidences and become an important part of audit documentation. 701 CAM is not applicable here. Okay, preparation of audit files. Now, this is a requirement of the standard of quality control number 1. It has to be completed within 60 days from the date of the audit report. And following changes can be made. I think I'll skip this, but this needs to be very important. And also, as per the SQC1, you need to maintain and retain the audit documentation for a period of 7 years from the date of the audit report. I'll just take 2 minutes and explain audit trail. So audit trail was introduced, I think, in 2023, wherein the company, only applicable to companies which are using accounting software. So for this part, I will not go for the detail. I just want to cover the audit documentation bit. Yes. So herein, I need to have evidence to prove that the company is using an audit trail feature, and the same has been operated throughout the year. There is the access is not revoked or it is not being tampered, and has been preserved by the company as per statutory requirements. So I need to maintain audit documentation to prove all these points as defined as per the company's audit and auditors rules. And in the report on other legal and regulatory requirements, I need to give specific assertion with regard to the point of audit trail. I'm sure for the past 2 years, everyone has been mentioning the recording. I think it's past, yeah. So this was, okay, 2024 was the first year when there was an assertion on audit trail in the auditor's report. So this kind of language needs to be done, and you need to mention these points regarding audit trail. So documentation can include sufficient appropriate record for the basis of auditor's reporting, evidence that the audit was planned and performed in accordance with the implementation guide on the audit trail issued by the ICAI. So with this, we come to end of our deck, and I had to skip few slides, but I think first we'll take up questions, and if time allows, I can cover them. These are my coordinates. You can contact me on phone or LinkedIn. I'm very active there.
So yeah, thank you. Thank you so much, Astha, for such an insightful and wonderful session. So yeah, now we have some queries we would like to ask from you.
Okay.
First being, so the first question is audit engagement letter required to be given every year if the one is appointed by the company for a period of 5 years?
Yes, because see, when you carry out the audit engagement, you do it for a one particular financial year. The point is correct that we are appointed for every 5 years, and then the replacement is done. Since your audit period changes, your financial statement period changes, you need to issue a fresh engagement letter. And it's not only for the audit engagement, any kind of engagement that you do, whether it's issuance of a certificate, whether you're doing a limited review, whether you are giving a projected report to the financial or to the financial institutions. So for every assignment, you need to give a separate engagement letter.
Okay, great. So that brings my second question. So can the engagement letter be signed in a client letterhead instead of a CA letterhead?
That will not make sense because you are addressing that letter to the client, that I am going to conduct the audit, or I am going to conduct a particular assignment, and I address it to my client, and these are going to be my responsibility, these are going to be your responsibility, these are going to be your terms. So I don't think it will be logical to, and how will you have access to the client letterhead? Because
Correct.
had the client been addressing any letter to you, that would be on a client letterhead, but since I'm addressing the engagement letter to the client, so it will be on the firm's letterhead.
Correct. Fantastic. Yeah. So the next question is, in what ways can technology improve the audit documentation processes while ensuring the adherence to regulatory requirements?
So this is a very, let me see, a broad question. And see, most of the CA firms, whether big or small, most of us are digitally maintaining our audit documentation. I doubt if there are some organization who are still using physical papers. If you are, then you neatly shift to digital. You can use a mix, like some portion could be physical, file, and majority has to be digital. Now, normally you can use like whatever basic folder structure you have. That's your Microsoft Office. You can use Google Sheets. You can use, you know, Microsoft One. There are some audit documentation tools available in the market. I'm not able to recall the one issued by the ICAI, but you can obviously rely upon them. But the problem with third-party tools is that confidentiality can be tampered, especially when you have your client's data in place. So you need to understand the terms and conditions from them, and what kind of technology they have in place to maintain the confidentiality, because it's very something we as auditors are privy to this kind of information which the client may or may not be comfortable leaking it outside to the world. So if you think that the this kind of third party which gives you resources for documentation is reliant enough, please go ahead and maintain them there if it helps you reduce time. I'm sure, I think ICI also has its own tool, and other than that, if your volume of work is not much, this basic folder structure can also help you maintain this audit documentation. I've already defined what kind of audit documentation has to be in
Yeah.
place, and so that the storage does not, becomes bulky for you to manage, because you have to maintain for a period of 7 years. It's long, and it has storage costs in terms of physical documentation or digital documentation. So keep that in mind.
Okay. So like after 7 years, can we destroy the hard copies or do we have to retain them?
So again, this is a litigative matter, because sometimes what happens is, let's say, especially, if a legal case comes upon the organization, if the auditor is questioned, and no, this is a requirement of the ICI, but I'm not sure whether the other statutes allow us to do the same or not. So
Okay.
for ICI perspective, 7 years is good enough. But beyond 7 years, and maybe you take a judgment call there that, a particular, depending upon the nature of the entity, if it's
Yeah.
sometimes, you can maybe classify your top 10 big clients and maintain them for a longer period. Sometimes what happens is that very recently I had this matter where I had a case of a VAT assessment of a client. Now VAT was, and that too for financial year 9-10. Now,
Okay.
9-10, we're sitting in 25, that was 16 years ago. Luckily, we had some, bits and pieces of data available. So we could carry out that VAT assessment successfully. But this is a one-off case. I'm not saying it may or may not happen, but for situations like this, Again, depending what is the nature of the business of the entity, what kind of assessments may come in place, it's better to keep them handy.
Okay, great.
And more importantly, ask your client to maintain them for a longer period so that you can depend on them. Because many clients tend to shift that responsibility on the auditor. That आप तो maintain कर ही रहे हैं, तो हमें नहीं maintain करने की जरूरत. That should not be there.
Okay, okay, great. Yeah, so the next question is, as per SA 230, documentation is the asset of an auditor. In case
Yes.
of a group audit, the group auditor, which is not a member of ICI, requests for a work paper. So can a Indian CA share the work papers to a foreign CA?
Okay. So I think I'll have to maybe read more about this particular question
Okay.
because I've not done any foreign audit. It's a very good question to ask. So
Yeah.
maybe this particular person can reach back to me later through LinkedIn or mobile. I'll study and then only able to answer this.
Okay, okay, sure. I believe those were all the questions which I got.
Okay.
And
Uh,
yeah, so now I would like to invite Mr. Anil sir for the formal vote of thanks.
Thank you, madam. Can you hear me?
Yes, sir.
Yes, sir.
Thank you so much, Asta ma'am, for wonderfully taking both these standards. You have covered all the aspects relating to both the standards with certain examples. And thank you so much on behalf of AASB of ICI for sharing your in-depth knowledge as well as insights for our members. We have gained a lot through your deliberation, madam. And thank you so much towards the moderator of today's moderator. Thank you so much, ma'am. It was a great learning experience with Asta madam. And thank you so much in spite of having busy schedule as well as some personal commitments at home. You have given your kind consent to deliberate for our members. So thank you so much for giving your kind consent for such a wonderful deliberation. And Rashi ma'am, thank you so much for wonderfully coordinating today's webinar. I also thanks all the participants of today's webinar. Thank you so much, everyone. Thank you so much. Good evening. Namaste.
Thank you. Thank you
Thank
for the
you.
Thank you so much,
opportunity.
ma'am.
Thank
Thank
you,
you so
Raj, for
much,
the
Rashi ma'am.
coordination.
Thank you.
Good
Thank you.
day.
Thank you.
Thank you.